Hello and welcome to Revision Tips for SIPS Level 5, Advanced Diploma in Procurement and Supply. This is Module 10, Logistics Management, Learning Outcome 1, which is to understand the concept of logistics management. We'll look at the role and activities, the concept of integrated logistics, the aspects of competitive advantage which you can achieve through your logistics management, and appraise the use of technologies as well. But we're going to start by defining logistics. Logistics is the flow of funds, goods, and information between origin and consumption. So it involves information, material handling, production, packaging, inventory, transportation, warehousing, and often security. And the Council of Supply Chain Management Professionals has defined logistics as the part of the supply chain management that plans, implements, and controls the efficient, effective forward and reverse flow and storage of goods, services, and related information between the point of origin and the point of consumption. And that's in order to meet customers' requirements. But a second, more concise definition is the management of inventory in the rest or in motion. So logistics management and the elements within it include integration of information, transportation, inventory, warehousing, materials handling, packaging, and security. But they fall under two main headings. You've got the inbound and the outbound. So inbound, these are all the activities from receipt of goods to the use of production line. So that will include inventory management, so the goods inwards, we're quality checking those goods, putting in place stock control systems and stock taking. You've then got the warehousing, the stocking, repackaging if required, monitoring of the conditions and holding those completed goods after production. Material handling is the short distance movements within the confines of a building or between a building and the transported vehicle. And then you've got the outbound, the movement of storage of products from the end of the production line to the customer, which will include packaging and security, and good practice techniques in the safeguarding of finished goods is necessary here. But distribution, which is how the finished goods are then sent to the customer. The transport is the means by which the distribution is undertaken. And information integration is vital to support these activities and cover both inbound and outbound requirements. Some introductory inventory concepts for you to be aware of. You've got something called a SKU, which stands for Sales Keeping Unit, SKU. That's the category or unit with a unique combination of form, fit, and function. You've got the minimum and maximum stock systems. That's a replenishment and inventory management system that sets the minimum inventory level used to trigger a reorder when the available plus incoming material total is less than the minimum. JIT, or just in time, an inventory reduction strategy that feeds production lines with products delivered literally just in time. That's developed by the automotive industry, and it describes shipping goods in similar but smaller, more frequent lots. Zero inventory, which is a just-in-time control term, the emphasis on reducing inventory to minimal levels and to reduce cost and promote organisational effectiveness. And then we have just-in-time too, a supply management orientation with a customer facility, also called in-plants. So supplier representatives place orders to their own companies for regular used contemporary, relieving the customer buyer from the task. We're now going to look at some of the inventory measures. These are measures, or methods, should I say, of measuring inventory, which can apply to all types of inventory control processes. You've got ABC inventory control. Stock items are classified as either A, B, or C according to their value and their importance. So the value and movements are managed accordingly, and this is the basis of the many key inventory performance measures. You've got average inventory, which is the average inventory level over a period of time. The sampling period is the amount of time between inventory measures. So daily inventory levels over a 2-week period. The average inventory for the same total period can fluctuate widely depending on the sampling period used. Then book inventory. This is an accounting term referred to the value or quantity of inventory shown in the company's accounting books. So example is inventory control database or your general ledger. So book inventory is compared with physical inventory during an audit process for validation and to determine any variances. Critical value analysis is a modified ABC analysis, which is subjective value and criticalness is assigned to each item in inventory. So assignment depends on the end customer or perishability, for example. Cycle inventory is a system where counts are performed continuously, often eliminating the need for these annual overall inventory controls. So they're set up so that A items are counted regularly every month, B items are counted semi-regularly, like once a quarter, and C items are counted perhaps once a year. Days of supply is the measure of the quantity of inventory on hand in relation to the number of days for which usage has occurred. The goal in most cases is to demonstrate efficiency through having a high turnover rate and therefore a low days inventory. The company must balance the cost of carrying inventory as its unit and acquisition cost with the potential loss of business and ultimately loss of customers if the shortage occurs. FIFO, which is first in, first out, is a term that we use where stored inventory that is used first. And in accounting, this is associated with value in the inventory, so the latest purchase prices are reflected in the book inventory. The practice of FIFO is common where products have a short shelf life. Inventory accuracy is the on-hand quantity equivalent to the perpetual basis plus or minus the designated count tolerances. This can be often referred to as a percentage, showing the variance between book inventory and actual count, a major performance metrics of any organisation that manages large inventory. Inventory turns is the ratio measuring how many times a company's inventory has been sold or turned over during a period of time. So the cost of goods sold are divided by the average level of inventory on hand. Operationally, inventory terms are measured as total throughput divided by the average level of inventory for a given period. Inventory velocity is the speed at which inventory moves through the defined cycle from receiving to shipping. Dock to stock is a practice where a pre-qualified product is received into inventory, eliminating the normal receiving and inspection handling involved. Also, a warehouse metrics used for benchmarking the amount of time required to perform the process associated with getting items into storage. Dock to stock cycle time is the elapsed time beginning with the delivery of goods from the supplier and ending when those goods are put away in a warehouse and recorded into the inventory management system. And then the number of stockouts is a situation where no stock was available to fill the customer or production over that pick operation. And stockouts can be costly, including the profit lost for not having that item available for sale, the lost production time, and lost goodwill of our ultimate customer. And lastly, shrinkage, the cost associated with breaking, stealing, or the deterioration of any inventory. It usually pertains to the loss of material through handling, damage, theft, or neglect. So here we can see the different areas of logistics, procurement, production, distribution, after sales and disposal. This is Porter's value chain, what you're looking at here. Now, procurement and logistics are inseparable links throughout a successful value chain. The role of procurement in logistics is procuring, sourcing, and contracts so that the purchase of materials, goods, and services enable an organisation to operate successfully. And the responsibilities vary from sourcing raw materials and services to managing contracts and relationships with suppliers. The importance of procurement can be hugely significant as the function can often be responsible for a very high percentage of a company's revenue, and therefore a small reduction in cost can have a huge impact on the profit. And procurement functions often talk about the 5 fundamental rights: getting the right quality, the right place, quantity, time, and of course at the right price. Logistics management has a huge role to play as they're responsible for the transport, storage, and warehouse and distribution of both inbound materials, usually on a global basis, to support production and shipment of the finished goods to the customer. Now, production encompasses the operations system which covers all the activities associated with manufacturing, including production control and quality control. It's responsible for the entire production system, which is a process that converts raw materials, labour and energy into a product or service that can be delivered to a customer. But pool distribution, which is a system where customers replenish orders, is sent back through the supply chain to initiate dispatch from the manufacturer, will manage quality, capacity, production planning and control. And it does interface with logistics in a value chain by receiving and drawing raw materials from stock and putting completed items or sub-assemblies back into stock in preparation for distribution. So the complexities of balancing supply and demand of the job are often managed via MRP, materials requirement planning systems, that control parts, bills of materials and production capacity. And some of the methodologies they'll use is obviously lean, which is a methodology that aims to create more value with fewer resources. Think about Tinwood, 7 wastes, or the 5 S's. And then you've got Six Sigma, a technique that's managing to identify any variability in the process, and it's about going towards zero defects. And then Agile, an Agile organization is one that has systems, processes that enable us to react quickly to a changing environment. And then you've got distribution at the other end, which relates to the outbound logistics. And as the name suggests, it's the collection, storage and distribution of the final goods and related information flows from the manufacturing plant to the end user. After sales and disposal and things like that are all part of the value chain as well. It's about being more competitive and that total customer experience that they get. So when the product is finally delivered to the customer, the elements of post-sale service and warranty management will kick in. In theory, the customer is delighted after sales service is extremely positive and no warranty claims or returns arise. But if they do, you don't want negative feedback to feed into your customer perception. But logistics is a term that's been around for a long time, emerging from its military roots, where the goal was to maintain army supplies during disruption by the enemies. A supply chain is a relatively new term and it's still developing, but it's commonly understood that logistics is an activity with the overall supply chain, and it's intrinsically interlinked with procurement, operations, and the end customer. So the logistics function is becoming more interrelated, with the across-company networks continually adding more services that are increasing their competitive advantage and allow more focus and investment on their real competencies. So a supply chain is the material and informational exchanges in the logistic process that stretch from acquisition of raw materials to delivery of the finished product to the end user. All vendors, service providers and customers are links in that supply chain. The primary focus is to link major business processes with and across companies in a high-performing business model that drives competitive advantage. Integrated logistics is where all functions that make up the supply chain are managed as a single integrated process rather than individually. It gives a comprehensive system-wide view of the entire supply chain from raw materials through to customer management. So total logistics management is the flow-oriented approach with the objective of integrating resources throughout the pipeline from the supplier to the final customer. To optimize this flow in terms of speed, cost and quality service, it's important to have the control of the elements of resources, the cost of performance of that pipeline. So this total logistics management will involve all logistic elements as a single flow process, not broken down by department silos, but recognised as an integral end-to-end function. One of the many reasons that an integrated approach in logistics and distribution is so hard to effect is the lack of cost information at every stage of the pipeline. Most organisation cost systems are set up by accountants who attempt to break down the cost by product type or cost centre. While this traditionally helps transparency and investigation at a granular level, it's not the best approach to looking at the total cost. So, for example, the cost of processing an order is a combination of specific costs incurred at various areas of the business, which can prove extremely difficult to bring together. The following actions, for example, all costs the company money but rarely quantified individually or collectively. So, setting the customer up on a system, carrying out a credit check, entering an order, sending a product, receiving a payment or reconciling a payment. In silos, each function favours activities that benefit only that aspect of the business. Whether it's marketing or estates or sales, the approach may bring savings to one area, but could bring costs to another. It generally restricts the flow of information around the company, making it more difficult to measure, adjust, and change the operation. So each manager identifies and justifies and defends spend within their own area, rather than feeling ownership across the whole process. So the following 5 areas of total supply chain management will cost them money. So you've got order management costs, material acquisition costs, inventory carrying costs, supply chain related finance and planning costs, and the total supply chain IT related costs. The total of these 5 elements give us the total cost to manage. So here you can see the total cost concept of logistics. And without a rapid and sophisticated approach to aggregate and analyse the cost data, it becomes impossible to reveal the opportunities for cost trade that lie within the logistics systems. Many logistics-related costs are absorbed into other areas of the business. The full process is not cost transparent, and internal systems do not exist that make it transparent. But as expressed by Martin Christopher in Logistics and Supply Chain Management, many problems at operational level in logistics management arise because all the impact of specific decisions, both direct and indirect, are not taken into account throughout the corporate system. Too often, decisions taken in one area can lead to unforeseen results in another. Change in production schedules that aim to improve production efficiency may lead to fluctuations in finished stock availability and therefore affect customer service. Now, inventory includes more than just the items on the shelf. The customer can take responsibility for inventory much earlier in the supply chain than has been traditional from the supplier dispatched area or from a port or an airport. But in many instances, especially with overseas shipments, inventory can remain in the transit pipeline for days or even weeks at a time. And a shipment of electronic toys from China can take a long time to arrive by container ship at a US port. And if the customer has already paid for the toys, they become part of the customer's inventory until they sell them to the end retailer. When the retailer purchases the toys, the pipeline inventory goes into their records. So this concept is similar to work in progress inventory where the product is still under production. But pipeline inventory is the finished goods and it's still under the process of delivery. But while the items are in transit, they're still considered to be part of the supplier's inventory if the recipient has yet to pay for them. When the recipient pays for the items, if the recipient has not taken physical custody of the item, the pipeline inventory goes into the recipient's inventory list. So it can be extended to include inbound inventory that are in transit. All these options are covered by the relevant Incoterms, and there's a separate video on the YouTube channel that covers the Incoterms if you're interested in looking at that in more detail. The metric calculator for pipeline inventory is lead time multiplied by demand rate. And calculating the pipeline inventory allows your business to more accurately track how much cash is tied up in your inventory. Businesses with typically longer lead times need to pay particular attention to this metric because an actual stock count does not reflect true inventory costs. So it's important not to be overlooked by the product when it's still belonging to the business and it's on the books, but is effectively in limbo. So you've got this static visibility. Where is it? What went wrong? Dynamic visibility is the ability to replan in real-time info. But the one at the end, the SCEM, which is supply chain event management, will enable you to anticipate, analyze, collaborate, and resolve. Now, multi-modal transport is the carriage of goods by at least two different modes of transport under a contract with one operator. But intermodal transport is where the independent contract of each of the transport carries could be done. So essentially, multimodal transport will have the shipping lines, the freight forwarders, and they can act as agents of the shipper. Or you've even got these NVOCC operators, which are non-vessel operating common carriers. So they act like shipping companies, but they actually don't own any vessels. What they do is provide documents like bill of ladings for the shippers to send to the forwarders, rented slots of the shipping line, they sell space. And depending on the company registration, specific rules apply to pricing for them to obtain licenses. But the company that holds the contract or bill of lading takes responsibility for the collection to delivery location, managing the relationship with all of the transport carriers across the different legs of the journey. So this would include managing timing along the route, even if there's a delay in certain sections, and that's to ensure the contract is discharged on time. Freight forwarders have become very important in the market as flexibility of their offering is now growing. And they give the following advantages. They've got experience in all modes of transport, land, sea, air, railway. They offer you a door-to-door service, even when the route that varies a combination of the air, sea, land, whatever. They can arrange storage for the cargo, distribution or forwarding as requested. They can negotiate freight rates, book cargo via the shipping lines. They can process your documents and issue approved in-house bill of lading. They've got the knowledge of over-border cargo movements and can arrange for customs clearance, offering you a complete international coverage. Now, source of competitive advantage through logistics. Martin Christopher stated that businesses compete in supply chains rather than standalone businesses, and that effective logistics and supply chain management can provide a major source of competitive advantage. A successful company will either have a cost advantage, a value advantage, or a combination of both to give competitive advantage. Now, cost advantage is about focusing on company internals to operate at a lower cost and gain a greater profit. It comes from operating at a lower cost, enabling that greater profit, and traditionally come through the manipulation of economies of scale across a broad spectrum of produced goods. Now, logistics cost represents a significant proportion of the total cost. Cost reductions can be made by streamlining that logistics process, and cost advantage can be gained and continue to deliver over the longer term. And further cost reduction, improved thinking and strategic partnerships must be there to bring those sustained benefits. But then the value advantage is the ability for a business to differentiate itself positively in the eyes of the customer from its competitors. And organisations can achieve such differentiation through their product offering and perception of their brand through customer service. And understanding the true cost of logistics, storage and handling, inventory carrying and outbound delivery will allow the business to adopt value strategies for delivery, speed, fulfillment and quality, which differentiate the organisation in terms of quality service. But now we're looking at matching logistics to a business strategy. The corporate strategy should involve answering questions from a portfolio perspective, like what business should we be in? A business strategy would look at questions about how should we compete in this business? And every business company has a different strategy depending on the size of the company, the market it competes in, and the skills it has available, as well as the amount of finance it has to access and to deliver the goals of the company. But the ultimate strategy is to gain and retain customers. But competitive advantage comes from the way in which companies organise and perform their activities in extended value chains. Then they must perform these activities more efficiently than their competitor, or in a unique way that differentiates them in the eyes of their customer. Generally, the approach of doing it falls into three categories: cost strategy, quality strategy, and service strategy. And the need to understand and meet customer requirements is a prerequisite for survival. The customer in today's marketplace is more demanding in relation to cost, quality, and service than they ever were before. So the role of logistics is to enhance the company offering in these three areas so you can maximize the opportunity for success. Now, customers in all industries are looking for greater responsiveness and reliability from suppliers. Reduced lead times, just-in-time delivery, and delivery tracking can help with serving and retaining customers. Loyalty, particularly with the growth of business-to-consumer markets or B2C. So logistics is the link between the supply base and the marketplace, and its scope extends across the whole organisation from conception to final delivery. Under this revised way of looking at an organisation, logistics management is the means by which customer service provides the customer requirements and makes sure they're satisfied. The output of all logistic activities is about delivering customer service. So we're just going to look at some of the service level agreement areas which you should determine jointly with your customer and supplier. And you can provide a standard against which performance can be measured, such as stock. This could look at stock availability. From an ordering perspective, you could look at order size, constraints, convenience, the status information, the cycle times, or the completeness. From delivery, you could look at frequency delivery and delivery reliability. Returns, maybe looking at the claims procedure. And for other areas, you may even think about technical support, the documentation quality, or in-hours and out-of-hours support that you may or may not receive. When it comes to measuring customer service, there are hard measures and soft measures and super measures. The hard measures will include stock, ordering, delivery, returns, or pre-transaction, transaction, and post-transaction activity. And it can be measured through counting or weigh-in, so metrics can be set up against each of these areas in a service level agreement. The soft measures are more difficult to measure and rely more on a scale of feelings or impressions. So this would include satisfaction, engagement, and brand loyalty. The super measures will include your customer retention, translating into lifetime value and customer profitability, which generates value for the business. Cost to serve is the process-driven tool used to calculate the profitability of a customer account based on the actual business activities and the overhead costs incurred to serve that customer. So it identifies unprofitable lines, profitable and unprofitable customers, and targets specific products and customers to generate profit. With cost to serve, it's possible to see what customers and products make the most money and which one loses the money. So knowing the true cost of every product, service, and customer allows organizations to segment their base into large or small-sized customers, regions, product range bought, or even profitability. And this allows them to compete more effectively. The cost to serve model, which is what you can see on the screen, can also help companies to identify unprofitable products and services, make strategic choices about which of these to drop or improve. And the model is arguably less resource intense than activity-based costing methods, as it uses aggregated analysis around the range of cost drivers rather than the precise details against every metric. So the benefits of the cost to serve model is it's less resource intensive way of measuring profitability than activity-based costing. It gives an integrative view of costs at each stage of the supply chain, providing a fact-based view on the complexity of multiple supply chains and channels to market. Allows a focus on both short-term prioritization of actions and long-term, more strategic decision-making. Provides data against which the repositioned customers and services and how they can improve the overall margin. But other methods will include which satisfies customers as promoters, which ones are passive, and which ones use theirs based on loyalty. So the CSAT measures satisfaction with product or service, and ServQual measures recognized elements of customer service. So as we know, businesses are searching for better ways to distinguish their products and gain long-lasting customer loyalty, as well as discover new profit sources. This movement has triggered the growth of service lifecycle management, and it focuses on serving a business after-market engagement. Companies have for a long time focused on integrating the process to manufacture and delivering products to customers, the product lifecycle management and supply chain management. However, few companies have embraced the integration of the process that happens after the product is sold and when the company services that product. So service lifecycle management recognizes and evaluates the gross income potential from customer service opportunities. These opportunities can be managed as a life cycle rather than as one-off events or ad hoc requirements. And it can combine every service-based operation into a single but complex set of workflows and associated business process. So it aligns all the elements of customer services, including service parts management, technical comms, field service management, product support and demand forecasting, to maximize the customer engagement. It can lead to service transformation and therefore maximize the profit opportunities from these activities. But there is a financial impact of logistics. And we know that logistics is vital and uniting focus of a successful business, both from the customer and the cost point of view. But from a financial impact view, logistics can transform a business. It can increase costs with long lead times, slow moving stock, inefficient distribution practices, and poor customer service. Or it can remove costs and accelerate profitability through tight pipeline management, supply lead time management, efficient processes, advanced distribution practices, and engaged customer services. Logistics is a make or break discipline for a business. So it's worth looking at the impact of that management of logistics and how that can have an impact on the bottom line, specifically the balance sheet. So here you can see the assets and liabilities and the logistic variables. So from a cash perspective, it's the order cycle and the completion rate. From the receivables, it's the accuracy of that invoice. And on the inventory, it's managing how much you've got in your inventory, as well as the use of the assets like the plant property and equipment. But in terms of the liabilities, it's the order quantities, the debt will look at the finance options, as well as any equity. So product coding is very important for all organizations in supply chain because it reduces the risk of ordering or delivering the wrong product. The choice of product coding is a decision for each organization in the supply chain. Such as barcodes. Why use a barcode? As we can see in the short history, A large and varied number of people have been trying to perfect barcodes for some time, in parallel with development in manufacturing processes, business management, and increased computerization. The reason all of this effort has been exerted is that all of these different organizations recognition and they recognize the benefits of being able to readily identify common product related information in different locations in machine readable format. Depending on the kind of product was moving along the supply chain, it's recognized as being able to send information such as use by dates for fresh food, a globally recognized part number such as a ISBN, which is International Standard Book Number, or an item number that's readable by a retailer, computer, or at key points in the distribution process, which would benefit accuracy in the supply chain. The first stage to use barcodes is deciding how to categorize the information and what information is needed in the movement of an item. Once you establish that, you can decide what type of barcode is most appropriate. So we have a UPC, which is Uniform Product Code, found in every retail product. A code 39, one of the oldest barcodes commonly used in electronics. You've got PostNet, used for encoding zip codes in US mail. Bookland is based on the ISBN numbers. Code 128 is widely used as many applications. Interleaved 2 of 5, which is used for products with limited space. And a coda bar used by logistics, education, and blood banks. These are all one-dimensional barcodes. When you get to the two-dimensional ones, you've got PDF 417, which is capable of encoding large amounts of text and data. It's stored and compressed. It's used to print postage, and it's also used by airlines and boarding passes. Maxi codes. These can encode 2 messages, the primary and secondary message, and it's used by UPS for sorting and addressing packages. And the data matrix is ideal for marking small items due to availability, to code 50 characters into an extremely small size, ideal for small products. And the QR code, most commonly used for tracking marketing initiatives like advertising magazines and business cards, is very easily read by a smartphone. But there are lots of advantages and disadvantages of using barcodes. I mean, it is time saving, fewer human errors, improved security, fewer paper records, not a lot of training time needed for your employees. You can improve the access to the data you hold and reduce the costs. But the downside, of course, is the cost of the initial investment in the technology and the scanning system. And the error rates. Label can sometimes get damaged, torn, or smeared or smudged, which can prevent the scanning process. We're now going to look at some of the order tracking technologies. It's not only large corporates delivering cars and pharmaceuticals that want information on the status of their deliveries. The growth in business-to-consumer activity has fueled the need for minute-by-minute status updates on orders and deliveries. So the order tracking technology often forms part of the warehouse management system application, from pick and pack to ship. There is also an order management module within supply management platforms that provide customer order information. From the time the order has been placed until it's delivered, the customer wants to know, has my order been picked and packed and is it ready to ship? Is that order correct? Are there any items missing or any problems with the order? Where is my order right now? And when will it be delivered? On the right-hand side, you can see EDI, which stands for Electronic Data Interchange. And where significant volumes of orders are being processed, one of the partners doesn't have IT infrastructure capabilities, EDI, you might be using spreadsheets, which can be used to send information. But EDI is a halfway house process that can replace the paper-based transactions, but is not one of a large corporate integrated IT system. Recently, web-based data exchange have become a cost-effective form of EDI. Many people involved have slowed down the process and can introduce errors, so order tracking systems will be independent of hands-on human intervention. But EDI uses an agreed standard electronic input format, and it can play a part in this. Next, we look at AIDC, which is Auto Identification Data Capture. And that's an umbrella term used to describe a range of different technologies that are used to identify and collect external data about certain objects. Examples of these types of technology include barcodes. Examples as well would look at RFID or biometrics such as fingerprints or iris recognitions. To capture data such as biometrics, sounds or images, a transducer is employed that converts the actual image or sound into a digital file. The file is then stored, and at a later time it can be analysed by a computer or compared with other files in a database, and it verifies identity or provides authorization to enter a secure system. So the benefits of this is that it's easy identification, it prevents errors and increases inventory accuracy, and of course the speed. And then RFID, radio frequency identification. This system consists of three parts. You've got a scanning antenna, a transceiver to interpret the data, and a transponder, which is the tag. All of these things have been programmed with data. So the scanning antenna emits short radio frequency signals that provide a means of communicating with the transponder. When the tag is passed through the scanning antenna's field, it detects the signal and transfers the data, and is holding up to 200 bytes. RFID tags and readers can be used to identify virtually anything physical, like equipment, pallets, stock, or individual parts of a product. But each tag contains a unique ID, which helps the system to identify each tag. It's attached to a specific item, and when the computer system is instructed to associate that unique ID of an item, it's attached to that product. And it contains a combination of unique IDs to identify specific products as well as some sort of recognition number, so they can easily be associated with a certain type or style of product. And the history of this radar or radio wave technology was developed, believe it or not, in the 1920s and honed during the World War II, and it was used to identify enemy aircrafts. But during the 50s, the technology developed to include partial non-military applications like electronic artificial surveillance or article surveillance or theft prevention device from shoplifting. But in the 70s and 80s, government laboratories and academic institutions developed the application for tracking an item, like a vehicle or a livestock. But since the year 2000, RFID technology has become more compact and less expensive, and its application has therefore become more widespread. As the cost of these tags reduces and has become more and more organisations require their suppliers to use them and adopt the technology will accelerate. So now looking at e-fulfillment in logistics technology, which means that there's a number of ways you can use it in a number of organisations, from large corporates to multinationals, all the way through to small home producers of niche products. Client orders may come in through the website and need to be promptly fulfilled and shipped. This can be undertaken in-house or at home by small producers or a third party. The choice is normally based on the scale of operation. Larger organisations are likely to choose outsourced experts like third-party logistics. But full e-fulfillment companies offer an end-to-end solution. They receive the custom-made products, put them in stock in the warehouse in unique barcoded label positions, and pick the product when the order comes in, packs them, hands them to the shipper, and then sends an automated email response to the customer to advise them that their package is in transit. They can also handle credit card processing, supply current inventory levels to the website, and trigger reordering of low stock products, or offer call centre services and handle returns. They provide extra services like kitting, labelling, sorting. So an e-fulfillment centre can provide third-party brand labelling and special packages to meet specific client requirements like Amazon and Walmart. And depending on the service required, the e-fulfillment center provides special software that allows for automated importing of fulfillment orders from each client's shopping cart and then returns the resulting fulfillment tracking and updated inventory back to the information in the client's cart. So you can see the activities here starting from the receiving, it goes into storing, picking, packing and labeling before dispatching with an advice note and if necessary managing the returns in the call center. And then the warehouse management system. This is a software application designed to support and optimize your warehouse functionality and the distribution center management. The systems facilitate a number of functions to store and move materials inside and outside the warehouse, such as planning, organizing, staffing, directing, and controlling of resources. There are various models that provide different functionalities, including warehouse design, that enables organizations to customize workflows and the picking logic to ensure that warehouse has optimized inventory allocation. For example, planning slotting to maximize storage space and account for seasonal or known production fluctuations. And then inventory tracking. This provides tracking of inventory levels in real time, improving inventory optimization. This enables the use of RFID or AIDC and the barcode scanners to make sure that goods can be found easily. It can also be used for tracking criteria like serial numbers. In the receiving and putting away, it allows inventory to be put away or retrieval. This is often with pick-to-light or pick-to-voice technology that help warehouses operate the goods or locate the goods easily. You've got pick and pack, picking for production and packing for customer shipment, a core warehouse task. It will produce pick paths to minimize travel distance of an order and increase replenishment rates. This can include zone picking, wave picking, and batch picking for maximum efficiency. Shipping allows for the warehouse management system to send bill of ladings ahead of the shipment or generate picking lists, invoices for shipment, and send advance shipment notification to the recipient. Yard and dock management assists the truck drivers coming into the warehouse to find the right docking. A more complex version of this model enables cross-docking. Labour management helps warehouse managers to produce workers and monitor the workers' performance. It uses KPIs which indicate workers who perform well above a preset standard. And reporting, a flexible offering which translates all the other data into the warehouse management system to produce reports on stock movements, cost of materials, and fast-moving items. This helps to identify areas of improvement and areas requiring an audit. Warehouse management systems are complex and expensive to implement and run, but investments in warehouse management systems are on the average returned between 1 and 2 years of implementation. Organizations can benefit and they gain that benefit, which justifies the complexity and the cost. The advantages of implementing a warehouse system is reduced labor, improved inventory accuracy, reduced pick and shipping errors, improved service for the customer, and a provision of highly accurate management reports. All data gathered under the warehouse management system integrates to allow the development of pull-based supply chains rather than push-based supply chains. Push-based supply chains are driven by long-term projections of customer demand, whereas pull-based supply chains are driven by customer demand, which allows the organization to be more flexible and responsive. And then finally, integrating system in the logistics supply chain. The area of logistics and logistics technology is becoming integrated at an alarming rate. The transformation of options for warehousing, storage, fulfillment, and transport is the driver by a revolution in customer demand. And that was unforeseen events as early as the early 2000s, and the benefits of things like an ERP system and the integration of logistics technology in warehouse management systems across the whole of the production line has meant that logistics has played a central role in the global customer supply revolution. It's turned a deeply traditional discipline and a conventional career option into one of the most advanced thinking and exciting career choices available. During 2018, Maestro, which is a global B2B marketplace partner, they conducted research on behalf of SIPs with over 500 European CFOs regarding their operational priorities. The research was commissioned to develop a better understanding of the procurement challenges facing chief finance officers and financial decision makers in the businesses across Europe. And 82% were focused on technology improvements by upgrading their IT systems and embedding digital processes. 62 of those were working on the IT systems and telecoms, and they planned to upgrade their systems. 33 were working in the IT and telecom sector. 21 said they were responding to upgrading their IT systems. They found it the hardest operational activity, but were trying to achieve it in the next 12 months. 30% said the innovation in technology was accelerated more quickly than their business was equipped to handle, and it keeps them awake at night. And 20% believe that IT system upgrades will be the biggest hurdle they have to overcome. So you can see on the screen, there's obviously examples of these ERP systems like SAP and Oracle and Microsoft Dynamics, and how it can integrate all of these systems together to give you better management visibility. You can identify products, picking lists, shipping lists, understand what's happening when it's halfway through the process, where it is in the delivery process. But ultimately, it helps to bring everything together. And that is the end of Learning Outcome 1. Thanks for watching.